A great company can still be a terrible investment. That sounds wrong until you look at what today's stock price is actually demanding. Nvidia is at the center of the artificial intelligence boom. Its revenue is surging, its technology is reshaping entire industries, and it has become one of the most powerful companies in the world. But under this valuation framework, Nvidia may need to generate roughly $1.6 trillion in annual revenue within the next decade just to justify the price investors are paying today. Tesla faces a similar challenge. To support its current valuation, Tesla may need to grow annual revenue to nearly $1.3 trillion, almost twice what Walmart generates today. This is not about whether Nvidia or Tesla are great businesses. They may be. The real question is, how extraordinary do they have to become before today's price makes sense? There is one number that reveals that answer before you ever click buy. When you open your brokerage app and see a stock trading at $100, $200, or $500 a share, it is easy to treat that number as nothing more than the market price. But a stock price is never just a number. It is an invisible contract between the company and the investor. That contract assumes the business will grow fast enough, generate enough revenue, and produce enough future cash flow to justify the money you are risking today. Suppose you could simply buy a broad index fund and target an average long-term return of roughly 10% a year. The moment you choose an individual stock instead, you are betting that it can deliver at least the same result, and ideally more. That means the company must achieve a specific level of growth. Not the growth management hopes for, not the growth a television analyst predicts, the growth already embedded in the price you are paying. The real issue is not whether the company is good. It is how much the company must grow before today's valuation becomes reasonable. A great business can still lose investors' money when perfection is already priced in. A more ordinary business can become an excellent investment when expectations are low and the price is right. You are never buying only the company. You are buying the expectations attached to it. Most investors are taught a simple rule. A low P/E ratio means a stock is cheap, while a high P/E ratio means it is expensive. The price-to-earnings ratio compares a company's current stock price with the earnings it has already produced. If a company trades at a P/E of 20, investors are paying $20 for every $1 of recent profit. That makes P/E useful as a quick screening tool, but it is not enough to make an investment decision. The reason is simple. P/E looks backward at what the business has already earned, while your future return depends on what the business can produce next. Imagine two companies trading at exactly 40 times earnings. The first operates in a mature industry. Its market is nearly saturated, its growth has slowed, and its profit margins are already close to their limit. The second is a younger company entering new markets, expanding its customer base, and still improving its margins. Both companies have the same P/E, but the valuation may be asking for two completely different futures. For the mature company, a P/E of 40 may require nearly perfect execution and years of unusually strong growth. For the younger company, that same multiple may reflect a realistic path the business is already following. P/E becomes even less useful when a company is losing money, moving through a cyclical downturn, or undergoing a major transformation. When earnings temporarily disappear or become distorted, the ratio can become meaningless. So, remember this distinction. P/E is a snapshot of the company's past performance. The implied growth rate is a contract with its future. To calculate this number, you only need 5 inputs. The first is the company's current market capitalization, the total value investors are placing on the entire business today. The second is its revenue over the last 12 months. We use revenue instead of relying entirely on earnings because earnings can fluctuate, disappear temporarily, or become distorted by accounting decisions and one-time expenses. The third input is your target return. In this example, we will use 10% per year. That gives us a reasonable long-term benchmark against the return an investor might expect from simply owning a broad index fund. The fourth input is your investment horizon. We will use 10 years long enough for the business to execute its strategy, but not so long that the assumptions become meaningless. The fifth input is the company's expected valuation at the end of that period. In simple terms, once the company is larger and more mature, how many times its annual revenue might the market still be willing to pay for it? A high-quality technology company might eventually trade at 8 times revenue. A mature retailer might trade closer to 1 or 1.5 times revenue. The appropriate multiple depends on the industry, growth potential, margins, and quality of the business. Now let's put the framework together. Suppose a company is worth $100 billion today and generates $20 billion in annual revenue. To earn a 10% annual return over the next 10 years, that company's market value would need to grow from $100 billion to approximately $259 billion. Now, assume that 10 years from today, the market values the mature company at 5 times annual revenue. Divide the required $259 billion market capitalization by that 5 times sales multiple, and you get approximately $52 billion in required annual revenue. The final step is simple. Calculate how quickly revenue must grow to move from $20 billion today to roughly $52 billion in 10 years. The answer is approximately 10% per year. That is the implied growth rate, the annual growth rate already embedded in the stock's current price. This number does not automatically tell you to buy or sell the stock. It does something more useful. It translates the promise hidden inside the valuation into a specific number you can test against the company's history, its industry, its competitive position, and the size of the opportunity ahead. Now, let's apply the same framework to 4 well-known companies. Start with Costco. Its P/E ratio is close to 50, which makes the stock look extremely expensive. But Costco generates roughly $294 billion in annual revenue. Using a mature valuation of about 1.5 times sales, the current price implies revenue growth of roughly 10% per year. Costco is already growing close to that rate. That does not automatically make the stock a buy, but it shows that a high P/E does not always mean unrealistic expectations. Now, consider Johnson & Johnson, a company widely viewed as stable and defensive. With a market value of roughly $560 billion, annual revenue near $96 billion, and a 5 times sales exit multiple, the stock may require about 12% annual revenue growth for the next decade. Historically, Johnson & Johnson has grown closer to 5% or 6%. So this supposedly safe stock may be priced for nearly twice its long-term growth rate. Next is Tesla. With a market value near $1.5 trillion and annual revenue of roughly $98 billion, even a generous 3 times sales exit multiple requires revenue growth of about 29% per year for 10 years. That would push Tesla's annual revenue to roughly $1.3 trillion, almost twice Walmart's current revenue. Tesla may succeed in robotaxis, artificial intelligence, energy, and humanoid robots, but at today's valuation, investors are not simply betting that Tesla succeeds. They are betting that several of those businesses succeed at enormous scale. Finally, Nvidia. With a market capitalization near $5 trillion and annual revenue of about $253 billion, an 8 times sales exit multiple implies roughly 20% annual revenue growth for an entire decade. Nvidia is currently growing faster than that, but the challenge is not one strong year. It is sustaining extraordinary growth from an already massive revenue base. To justify the current price, Nvidia may need to reach approximately $1.6 trillion in annual revenue within 10 years. The market is not merely asking Nvidia to remain the leader in artificial intelligence. It is asking the company to become one of the largest revenue-producing businesses in history. 4 stocks, 4 different lessons. Costco looks expensive, but its expectations are close to what the business is already delivering. Johnson & Johnson looks safe, but its valuation demands growth far above its historical record. Tesla is priced for a massive future. Nvidia is priced for unprecedented performance at unprecedented scale. That is what the P/E ratio alone cannot show you. Before buying any individual stock, spend 5 minutes running this calculation. Start with the company's current market capitalization. Then find its revenue over the last 12 months. Choose your target return and holding period and estimate a reasonable future valuation multiple for the industry. From those inputs, calculate the annual revenue growth the company must deliver for today's stock price to make sense. Once you have that number, compare it with the actual business. Has the company ever sustained that level of growth before? Is its addressable market large enough to support it? Are competitors getting stronger? Can profit margins continue expanding? Or would the company need to launch entirely new products just to reach the target? Then ask the most important question. Do you honestly believe this business can maintain that growth rate for many consecutive years? If the answer is yes, continue your research. If the answer is no, walk away. Not because the company is bad, but because the price is demanding more than the business can realistically deliver. This framework is not an automatic stock-picking machine. It will not give you a perfect buy or sell signal. It is a filter that helps you avoid paying today for a future in which almost everything has to go right. Your brokerage app shows you the stock price, the chart, and the P/E ratio. Financial media shows you record-breaking quarters, explosive revenue growth, and bold announcements from management. Influencers give you compelling stories about the next great company, the next technological revolution, and the next stock that could change your life. But almost no one tells you what the current stock price is quietly demanding from the business. So, from this point forward, stop asking only, how high could this stock go? Ask a better question. How large must this company become before the price I am paying today no longer looks like a mistake? Because a great story cannot protect you from unrealistic expectations. A popular company cannot overcome impossible mathematics. And a rising stock price does not guarantee that the business can grow fast enough to justify it. Do not buy the story before checking the numbers. Calculate the growth the price requires. Compare it with what the business can realistically deliver. Then, make your decision. Run the number first. Decide second.